So how you doing? This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options trading program. If you want to learn more about that program, go to www.highestpaidparttimejobintheworld.com. And so what we're going to really quickly get into is how to play NKLA, ticker NKLA, with put options. And this is going to be a really good video for people that really don't understand how to play the put side, because what you see in the options market is that especially when you're on social media, you're seeing a lot of people that are really good at playing the upside. But one thing that I've really found a lot of success at is playing the downside of situations. And the reason why I think a lot of people like to play the upside is because a stock can go up indefinitely, right? When you're playing the downside, you have a lot of limits involved because there's no way a stock can go down indefinitely, because once a stock hits zero, well, then all the value is out of the stock. So I think because of that reason, a lot of people really struggle in understanding that there's a limit, right, in how much the downside is going to be available to you, right? What's going on, Joey? If you could like and share when you come in. There's a downside of, there's a limit to how much can be available to you from a profit standpoint, because if the share price is $30, well, then it only can go down to zero. If the share price is $100, it can only go down to zero. Where we understand theoretically, when you're looking at a stock on the upside, if it's $30, well, it can go up to $1 million. If it's $100, it can go up to $1 million. So the upside is going to always be unlimited. The downside is going to be definitely limited. And I think that's where a lot of people struggle in the put options. And so what we're going to talk about is give you a really good case study, because I can see this situation setting up for a lot of people. And then what they're going to do is they're going to come back and not really have an understanding. And one of the reasons is why, because they took their hint to make this play from somebody off YouTube that is not going to really walk them through the actual steps of how to play this the right way, so you come in the right way so you can exit. And a lot of times when it comes to put situations, less is always more. So less contracts, right, and trying to get less profit and getting that profit is always more than more contracts and also trying to get more profit. So let me show you what I'm talking about. So we're looking at NKLA, right? They're an electronic vehicle alternative energy vehicle corporation. And what we're seeing is that there's two catalysts, right, that are driving this share price down. One was that they were supposed to be in a deal with General Motors. The deadline of that deal was supposed to be December 3rd. General Motors came out on Monday and said that there's going to be no deal. They'll just use this company as a supplier if they can produce something that General Motors is interested in. Second reason is that they came out of lockup on December 1st. And what that means is that a certain amount of shares are going to be available to the public to be sold. And so what a lot of times that happens is once those shares hit the market, a lot of times the original people that bought in, the original investors, if they think that at that current share price, that return is acceptable to them, a lot of times they will sell, right? So what a lot of times that will do is put downward pressure on the share price. So when we're looking at this particular share price, so let's look at the 1 year first. So we see at one time it was around, it opened one time at $93. So I've been looking at this company for a very long time. I just didn't have the ability to get in at this price point, because when it hit 93, I knew that was outrageous. I knew they didn't have anything to really stand on as a company, but I wasn't able to get in at this price point because what I would have done in a best case scenario for me, I would have got in at 93 with put contracts probably going out to September. Then there was another time where it hit around here, the $50 mark. And I still was not able to get in the way I wanted to, right? And I would have probably got contracts at the $50 mark going out to the first of the year. So what we're looking at a 5-day is we're seeing that once the news came out that GM was not going to use them or partner with them, right? Because GM essentially was going to take equity out of this company, right? And help them manufacture one of their vehicles. That was not going to be the case. Then also lockup approaching. So what we have on 11/27 is that they closed around 27.65. When they opened up that Monday, they opened up at around 21.50. So I bought a put contract the week ahead of time. Well, why did I do that? What was my confirmation? Well, when you're dealing with a company like GM, right? They're a well-established company. They've been around a long time. They're very much about business. They're not going to drag their feet on whether or not they're going to partner with you. That's what you get when you're dealing with mom and pop businesses. A lot of times they're undercapitalized and you're not dealing with really, really savvy business people. If GM's going to do a partnership with you, they're not going to wait until the day of the last date in which they can actually announce it, right? Unless there was some furious negotiation going on behind the scenes, and that wasn't the case. GM had decided a long time ago, I think after the Trevor Milton incident, that they're not going to partner with this company. They just didn't come out and say it, probably because they didn't want to destroy the company and make it look like they were trying to destroy the company. So when I saw that we could never get the confirmation of the partnership, to me, a lot of times in life, you got to look at what's not being said as opposed to what is being said. I realized that they don't have a deal with GM. And then I realized also they're coming out of lockup, so that's going to put a lot of downward pressure on their stock. So what I did was I got a put contract that at that time was above the money, right? And then I said, if I like how it looks this week, I would just layer my position, right? And what I mean by layering my position is I would just continue to add to that same position, right? Maybe at different strikes or maybe at the same strike, depending on how it looks. But I didn't want to go crazy because I wanted to see how the situation developed. What a lot of people have done, because like I said, as they're following the people in YouTube world, is that they went in and they bought multiple contracts at different strike prices. And I'm going to show you what I mean by that. So they go into the options chain, and first mistake they do is they buy the earliest expiration date. So that's December 4th, right? Which is this Friday. They buy the earliest expiration date, and then they buy multiple strikes, right? So they'll go from like 25, right? 25, and then they'll go all the way down to like $10 or $5. And if you look at the $10 strike, you got 32,000 open interest, right? Look at the $15 strike, you got 10,000 open interest, 7,000 open interest, right? So you're seeing is that all the open interest for the December 4th, right, is at under the $10 mark or at the $10 mark and under, right? Then you got under the $15 mark, at the $15 mark. This is where you have the majority of open interest. 17, you got 6,000. So what people were expecting with this particular company is they were expecting, right, what I call a total collapse. Now, let me explain something to you. When you're looking at a company, the majority of the time, and especially with well-established companies, NKLA is different because it's a newer company. But normally the time when you're looking at trading activity, what you're going to see is that it's going to trade within a range, probably 80% of the time, maybe even 85% of the time. So that means that you're going to get either a breakout or a breakdown around 10 to 15% of the time. So understanding that those numbers are true, if you believe these numbers to be true, once you get this gap down, what are you going to get? It's going to go back into a range. Because the only reason that you would buy, right, short-term options at the $10 mark, at the $5 mark, is if you believe that you're going to get a total collapse in this share price. What do I mean by total collapse? I mean that it's going to be $5 by today, which is Wednesday. Because what you're going to see tomorrow, and you're probably already seeing it now because we're getting ready to close, is that the value of these contracts are going to start to eat up. Now, they only paid $5 for them based on this. I wouldn't use this number as a quote because it could be different once you get inside your brokerage account. But what you're going to see is that the premiums of these particular contracts are going to start to erode very, very fast. Why? Because they're expiring right on Friday. And so you got to understand is that when you have these type of situations, a lot of people, because they really don't understand what I call the fundamentals of the situation, they get excited and they a lot of times overextend themselves. So the two things that hurt options traders is one, your structure of your play is wrong. The second thing that hurts options traders even more is you didn't manage the play the right way, which is normally a breakdown in your psychology. So you can structure the play the right way and manage it the wrong way and still lose because your psychology broke down during management of the play. Or you could structure the play the wrong way and it doesn't matter about management because the way the play has been structured is not going to work. So let me give you a scenario in which you would buy these short expiration date contracts way, way, way out of the money. Let's say hypothetically, right? When we're playing directional options, we're playing naked directional options. And that's one of the things I specialize in is naked directional options. I'm not a spread guy, not an Iron Condor, not an American Eagle, not a California Eagle guy. That's not what I get into. I get into naked directional options. When you're playing naked directional options, what you're looking for is sustained momentum in one direction, either up or down. So what you would look for if you're going to buy that 5 or that 10 is you would have to believe that we're going to get a massive amount of movement down, approaching that $10 mark and then even approaching that $5 mark. And it has to be massive. So what we would have had to see is that it gaps down, it opens at 17, right? It gaps down and it closes that day, which was yesterday, right? It closes at, which is Monday. My bad, it was Tuesday. It closes at, let's say, $10. And then because we gap down around 25%, and then we close at another probably 10 to 15 to 20%, because you got so much momentum in that downward direction, what will happen is this. When you looked at those contracts, right, what we saw is that they had premiums on them. The market makers will raise the volatility, which will make those contracts more expensive. But because it's moving in that direction, you're going to get more demand on those contracts. So let me show you what I mean. So what happened is that we start getting that really, really powerful downward movement, right? The premiums on the contracts are going to go up because what? The market makers are going to raise the volatility prediction, which means the contracts cost more. But because it's moving down, you're going to have more people going into the market to buy these particular contracts. And all you're going to do is make money off the increase in the volatility, the increase in the premium, and that's when you're going to exit. That's one way to make money. The second way to make money is it actually falls beneath these numbers to where either you're at the money or under the money at expiration, and then therefore you can exit the play with a profit. But if you don't get that really volatile movement down, what's going to happen is we're going to hit Thursday, we're going to hit Friday, and the contracts are going to start to lose premium because look at the volatility on this. It's 637. Do you know what kind of movement you're going to have to get to make that go to 15 cents? Now, the great thing about it is that it's only a $5 contract. So if you have the money to spare, you can buy $200 worth of those $5 contracts, right? And if that $5 goes to 15 cents, you cashed out. But you're going to have to get a very, very, very violent movement to increase this premium. Why? Because the volatility, the movement has already been baked in at 637% volatility. You got 312, 246, 228. The volatility numbers on everything at 1350 and under is bananas. So you got to understand is that when you're looking at these volatility numbers, the market makers essentially have already baked in the movement. So you got to get a very, very, very aggressive movement in that direction, right? For them to believe that, you know what, this situation is even more volatile than what we thought, right? So then therefore we can increase premiums on these contracts and sell them and still drive sales to this, because the market makers, their only job is they're just trying to make money on these contracts and they're hoping that they expire worthless and then they get to keep all their premium. And then the person who may owns this is doing cover calls. They can sell above the ask if they want to, right? But the market makers are the people that are really creating the market for this. And we're talking about, the people whose job it is to trade this particular stock for whatever outfit that they're working with. So you really want to understand when you're looking at these kind of situations, you have to understand two things: setup, structure of the play. How was the play structured? What I would have recommended, and I'm not a financial advisor, I'm not a fiduciary, so you didn't want to look at this just for education and entertainment purposes. I said before, if you believe that there's going to be a lot of downward movement on this because you know that you feel like the GM deal is not going to be any good, you also know they're coming out of lockup. Buy as close to the money as possible. And then buy an expiration date that's not a week out. See, short-term contracts are very seductive because they're inexpensive. The problem is they're very volatile because if you don't get the movement that you want, as soon as you don't get the movement, it hurts you. So when you're playing directional plays, they're directional. So horizontal movement is just as bad as the movement in the opposite direction. Why? Because the volatility and the theta decay is going to kill your contract premium. So you really got to know what you're involved in. That's why a lot of people like to run the spreads and things of that nature, but that's a whole nother concept. But when you're playing directional movement, right? So let's go back to the chart. You're playing directional movement. This is terrible. This is the worst thing you want to see. Why? Because there's no direction, right? Then what happens is on 12/2, it comes out it spikes up, it goes down, it spikes up again a little bit, it goes down. But this is pretty much almost horizontal movement. And what I don't like to see is the fact that it closed at, let me see what time it closed at. It closed around here. What did it close at? Closed at 1724. It comes back out today, right? And it opens at 1770. That's the worst thing you want to see. Why? Because it's opening higher than the last close. Then where is it at right now? It's at 1805. So right now it's higher than yesterday's close. The volatility and the theta decay is going to kill the contracts. Because what we're doing is we're making directional plays. We need to see this thing continue to lose share value. It can't trade horizontal. It can't close higher than the last day's open. We need to see a consistent losing value every day. And so that's why you got to be careful, right? When you jump in and you just start buying, right, all of these particular contracts, right, at multiple strike prices, even though they're cheap, even though they're inexpensive, because just because it's cheap and inexpensive don't mean that it's a no risk play. A lot of people perception of no risk is cost, right? Perception of, their perception of it's not a risky because it don't cost a lot. That's their perception. So the market makers understand that's perception and they understand how to leverage that and take advantage of it, right? The reason why the volatility can be lower in the money, right, is because there is you're already almost in profit at any forward movement that you get down. So I really want you to understand when you're looking at these kind of plays, especially on the downside, the most important thing you got to understand is this. You're going to hit a wall. What's the wall? The wall is zero. The wall is zero. Options don't trade using negative numbers like integers. So the wall is always zero. So it can't go into infinity. When you're looking at calls, what a calls can do? Calls can go into infinity. If Tesla comes out tomorrow and say we got a spaceship, right? It's a car and a spaceship at the same time. It's coming out first of the year. And come to the live stream and we're going to show you what we're talking about. It's at 12 o'clock p.m. Eastern Standard Time. And everybody jump on a live stream. And true to their word, they got a car and a spaceship at the same time. Tesla goes to $100,000 a share by the end of next week. Because the upside is always indefinite in the stock price. The downside is what? Zero. So you got to understand that there's a wall that you're going to have to hit. So the question is, what is going to be the direction of movement towards that wall? And what scenario is going to cause a lot of speed and momentum as we get closer to zero? But we can't go under zero. So you got to understand is that in a lot of times when you're looking at put plays, you're going to get a lot of downward momentum. And then what's going to happen is you're going to hit something that we will maybe call institutional support. So looking at a company like this, right? What is an institutional support that we're just saying off Yahoo? I would do a little bit further research. It's around 13%, right? So we know that there's probably going to be some kind of floor here to where it's not going to go under a certain number, but you got people at $5. You got people at $5 strikes. You got people at $10 strikes. Well, what do they think the institutional support is? Who are the people that bought in for $5 and $7 where they're not going to sell because their attitude is that I still believe in the company and I bought it at such a low price point. I don't care that it's 18 or I don't care that it's 10 because I've doubled my money. If you bought it at $5 and it's $15, you tripled your money. So you may decide to hang on for another 6 months to a year. So you're not going to get a lot of selling at those particular price points. So these are the kind of things that you got to think about because when you're looking at the put game, you are going to hit a wall. My biggest mismanagement of every play is on the call side because I still have issues with upside of plays. Downside is easy because I already know what the wall is zero. So then my question always is that how do I have to structure this to take advantage of its fall towards zero? Where do I think the institutional support is that's going to start to make this thing level out to where I'm going to have to exit, right? Because right now I'm looking at probably exiting this play before the end of the week, even though my contract expires towards the end of the week. And the reason why is because it's trading horizontal. And if it's trading horizontal, it's not doing me any good. I need this thing to continue to fall. But what I'm thinking is I'm seeing is that we're seeing some support around the $17, $18 mark. And I'm thinking that we're going to get day traders in here. And then what they're going to do is they're going to prolong the collapse of this particular ticker. And what that doesn't do me any good. Why? Because I'm a directional trader. I trade naked options off directional plays. So the day traders coming in here, or it being a very slow bleed, right? As people start to unload their shares because they're out of lockup, that doesn't help me either. I wanted this thing at $10 by Thursday or Friday. Then I was going to exit. It don't look like I'm going to get that. So I may exit on Friday. I may exit on Monday. But like I said before, is that what I knew not to do is come in and buy a cascading down of strike prices, especially on the short term. Maybe you want to look at that on the long term, right? But on the short term, it's the worst thing you could do, because if you don't get that really, really violent directional movement, the volatility that's already been baked in, so the movement has already been baked in by the market makers, and the theta decay is going to eat all the contract up. And so if you're in for $5 and you got one contract $5, it's whatever, because it's a $5 loss. But the way to really leverage this kind of play is to buy $500 worth at $5. Because if you can get it to go to 10 or 15, you cake off, right? And so I wouldn't take these things, these particular premiums, I wouldn't take these to the bank. I would go inside your own brokerage account. But I want you to understand is that a lot of times these out of the money short-term options are priced to sell. Just because they're priced to sell doesn't mean it's the best situation for you to be in. And we're going to talk about before. People think because something is inexpensive in their mind, they think that means it's low risk. And because they believe that, then people know that they believe that, and they're able to leverage that to take advantage of that situation. So if you want to really get more understanding of how to take advantage of these type of situations, because one thing I will, and I'm not trying to toot my own horn, but I feel like I'm very exceptional at put plays, right? I feel like I'm very exceptional at that. I had a 6-year run, well, like, not a 6-year run. I had a 6-month run to where I really, really, really was killing it with puts. And then I started playing Tesla on the upside. But I really don't like playing calls like that. It's just, I don't. Because to me, it's way too many variables, right? That and things can go wrong with a put. I already know that we're on a race to zero, right? And then I know I just got to try to figure out how to structure a play to take advantage of that race to zero. And when do I think institutional support or day traders are going to rush in, right, to try to keep this thing from decomposing or self-destructing or imploding as on the way down. And once they come in, I'm out, because they'll day trade this ticker for the next, they'll day trade this thing to the end of the year, and it'll stay between like $12 and $18 to the end of the year. And they'll just day trade it back and forth, because that's how they make their money. And so what you got to understand is that when you're in the market, you're in an ecosystem where people make money different ways. You got day traders, you got swing traders, you got people that do leaps, right? You got scalpers. You got a bunch of people. It's kind of like an African savanna. And you look out on the African savanna, you got all these different animals. Well, they all live in the savanna. They all eat food. They all drink water. And so they all have to live doing their respective things. And it creates a balance in the ecosystem. When you're looking at the market, you got people that make different type of plays, different ways. I'm not really a good scalper. I'm really a better swing trader and elite trader, right? You got people that are really good at scalping. You got people that are really good at day trading. You got people that are really good at swings. So you understand that when you have certain situations, different people are going to come in, and that's going to be their time to eat. What does that mean? It's your time to exit. Because if you try to eat with them while they're eating and you don't know how to eat the same way they eat, you're going to have a lot of issues. So you want to understand when you're looking at certain situations, you're going to have your time in the situation to ride the wave, and you eat and you get what you want to get out of it. Then another group of people, they're going to come in and they're going to eat and they're going to get what they want to get out of it. And it's not really good for you to try to conflict with that group of people unless you know how to eat the same way they eat. So when you're looking at this type of situation, I always ask yourself, how do I need to structure it, right? So I can benefit from it. What does my exit look like? And then how do I manage the trade, even if it goes the way I want it to go? And then also if it doesn't go the way I want it to go, how do I manage it? Because the two things that hurt options traders is, one, structure. How did you structure the play initially? Second thing that hurts the majority of people, myself included, right, is how did you manage the trade while it was live? And a lot of that falls back down to psychology, right? How did you manage the trade while it was live? If you took a loss, did you cut your losses early and leave? Did you try to sit around and hope that the play could recover? Did you take profit as soon as it appeared and leave? Those are the trade management issues that defeat people, even if they structure it right from the onset. So if you want to learn more about how to make money on plays like this, reach out to me. because I think I'm up currently. I know I'm up greater than 50%. I don't know what percentage it is, but I know I'm up greater than 50% on this particular play, and I believe I bought this play last week, so I was probably up 50%. So I'm looking to exit right on this play and just take my profit and go into another situation. So if you want to learn how to really take advantage of these type of situations, because you're going to see a lot more of these because of how many EV companies are going to be coming out in 2021, reach out to me on Facebook, YouTube, Instagram, wherever you see me on social. This is David W. Williams, also known as Diamond Dave, and I'll talk to you later.